smokers, this ain't no dang jokers. Everybody that is a Meta shareholder out there or a Microsoft shareholder, congratulations to all of you guys out there. Hopefully it was a good day for you. We were up $37,000 here today on Meta stock in the public account. But you know what? We're in earnings season, which means up next, very next day, Amazon reports here today, right? My fourth biggest position in the public account, so far up $87,000 on that position. So Apple and Amazon are both moving down after hours. We're going to go through what just happened with these stocks. And also we're going to speak in this video, where are these two stocks headed now? Where's Apple stock headed? Where's Amazon stock headed? I'm going to show you, especially in regards to Amazon, exactly where this stock is going, not only this year, but over the next several years. I'm going to lay that all out for you guys in this video here today. So I think you're really going to enjoy that. From there, we're going to react to a couple of, three videos in particular, since this is the reaction channel after all. By the way, I appreciate y'all for being here. All I need from you guys, smash that thumbs up button. Please do it for me. It means the world, okay? And additionally, if you want to subscribe to the channel, you can certainly subscribe. We just hit a new all-time high subscribers in the history channel yesterday. So appreciate each and every one of you. But we'll react to a few videos up here. Fast Money Traders talking about Amazon stock and their opinions, and I'm looking forward to reacting to that one. Then we're going to react to this one, Meta Microsoft boost AI bulls, but CapEx cracks are showing. That should be an interesting one to react to. And he's back. Mike Wilson, not convinced equity rally is sustainable beyond 56.50. Wow. Mike Wilson, we haven't heard Mike Wilson for a bit as far as being kind of that bearish tone. This man was very bearish kind of back in that, I remember him being very bearish back in kind of like 22 into 23. And then I think he finally capitulated at some point last year, if I recall. And now all of a sudden it seems like he's coming back. Sometimes these folks that lean bearish, they're just waiting to go bearish again, and it looks like he's back bearish again. So by the way, I appreciate everybody joining me as always. Got a lot to go through in this one. And additionally, pin comment down there today if you're looking to apply, join a private stock group, get access to all my course curriculums like Become a Master Stock Market, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, as well as access to my private Discord chat, all that good stuff. Pin comment, click on that, fill out a form, see if we can get you access maybe a little later on this week, maybe this weekend or next week. I don't know. We'll see. Okay. Alrighty. So Apple, A- income statement here. Pretty, very respectable income statement from Apple, considering they don't have any hyped products in the market right now. And this is still very solid numbers for the company. They came in with product sales, almost $69 billion versus 66, right? Services revenue came in at $26 billion versus $23 billion. Total net sales came in at over $95 billion in the quarter versus 90.7. So, we can call it, what is that, about a $4.5 billion increase on a year-over-year basis. It's impressive. Good work, Apple, right? They kept their expenses in check. So gross margin dollars went to $44.8 billion from $42.2 billion. They also kept research and developments in SG&A in check as well. So operating income went to $29.5 billion from $27.9 billion. Nice increase. Net income went to $24.7 billion from $23.6 billion, and diluted EPS $1.65 versus $1.53. So certainly not a perfect income statement, but respectable, very respectable numbers from Apple overall, which once again is impressive. Like, think about it. This company doesn't have any product in the market right now that is hyped, that everybody's like, I got to go get the new Apple, blah, blah, blah. And they still put up a very impressive quarter. Good on Apple, right? Now, additionally, a lot of people were scared about the tariff situation in regards to Apple and what that's going to do to their business model. But what's interesting? Based upon Tim Cook's numbers here, it doesn't sound nearly as scary as you might have thought. Apple estimates tariff impact will add $900 million to cost in June quarter. $900 million? Nothing. Look at the numbers Apple's doing. You're talking about a company that does almost $100 billion in revenue. Almost $100 billion in revenue per quarter, right? We're talking $900 million. That's nothing. So the tariff stuff, man, you would have thought, it's got to be, in the billions and billions of dollars. It's not, actually. So, I don't know. Apple, that's actually pretty darn impressive there, right? Now, you know what's crazy? I don't think anybody's ever pointed this out and talked about how crazy this is. But I got to do it for you guys, okay? I'm going to point out how insane this is. Apple has only shareholder equity of $66 billion. Now, if that's almost any other company in the world, $66 billion of shareholder equity would be a big shareholder equity amount. But for a company that has a $3 trillion plus market cap on it, it's nothing. Literally nothing. And so, what's interesting about that is it goes to show you a couple things. One is how asset light Apple's business model really is, that they have that little in shareholder equity, right? $66 billion for a $3 trillion market cap, that's nothing, right? And the second thing, what that shows, I think this is very important that everybody understands this. That is because of the massive share buybacks they've done over the last decade. Because do keep in mind, if Apple would have chosen not to do all the shareholder buybacks, which, by the way, there's nothing wrong with the shareholder buybacks. I'm just pointing out, if they wouldn't have done that, let me be very clear to you guys. Apple would have shareholder equity right now of somewhere between $500 billion and $1 trillion on this company. They would have the biggest shareholder equity probably of any company in the world, just to be quite frank, and certainly of the big techs. It would have been a ridiculous number. But they've decided to elect for share buybacks, which, speaking about share buybacks, they announced they're going to buy back another $100 billion of company stock. Now, do keep in mind, Apple's now, a $3 trillion plus market cap. So, $100 billion doesn't go as far as it used to go. And what's interesting is I was looking at some shareholders and kind of their response to this, and some are disappointed, folks. Disappointed in Apple's only buying back $100 billion. Some are scratching their head that's it? So some people thought at least 125, if not 150 billion, if not bigger than that. So actually some people are actually a little scared that Apple's only authorized a $100 billion buyback, which is crazy because it's just a ridiculous amount of money. Imagine doing a $100 billion share buyback and people being disappointed, but that's what's going on here. Additionally, if you do own Apple stock, do keep in mind they just upped your dividend as well, which is very, very nice, okay? Now, what about Amazing Zon? Well, I don't know if you guys follow me on X or not. I always have that linked in the description area, as well as my Instagram as well. So if you use Instagram or X and want to follow me on those platforms, that's always linked in the description. But in regards to Amazing Zon here, I posted this here on X. I said, revenue slight beat about $600 million. EPS was a very nice beat, $1.59 versus $1.36 was expected. I'm happy, buy, right? And so those are beats, but it's not Smash Factory. And in this market, to really have your stock blast higher, you've got to come through with smashing. Because everybody's uncertain right now. All these people are scared to even buy any stocks right now. The international people are holding out because they want to prove a point. And so you're in a weird market right now where people are scared to buy. So if the only way you can really get a massive move up in a stock is you got to come through with the Smash Factory on earnings. If you come through with just beats, it's not good enough. Not in this market right now. Let's be very, very crystal clear about that. No. Amazon's income statement, banger, grade A. Look at this. Net sales went to $155 billion from $143 billion. That's a $12 billion, about a $12.2 billion increase on a year-over-year basis. Cost of sales, it kept that in check. Fulfillment was a little high. Technology and infrastructure was a little high in regards to that. G&A actually dropped on a year-over-year basis. Think about that. They spent less on G&A and increased their revenue $12.2 billion. Jeez, these companies can run lean, huh? Incredible. Operating income blasted higher to $18.4 billion from $15.3 billion. Interest income was higher. Interest expense was down. Let's go, baby. So I'm talking about. And also had some other income there, about $2.7 billion. Now, look at the net income. $17.1 billion versus $10.4 billion in the same quarter last year. Diluted EPS, $1.59 versus 98 cents in the same quarter last year. Grade A income statement for Amazon. If the revenue growth was stronger, I would have gave them an A+. Let me be very clear about that. But since the revenue growth was, kind of that 9-ish% range somewhere in there, they get a grade A, not an A+. But they were close. It was close to an A+. Now, if you want to see a big boy balance sheet, look at Amazon. This is a big boy balance sheet. Keep in mind, Amazon's market capitalization is probably about $1 trillion less or so than Apple. But yeah, look at the stockholder equity. It's about 6x, roughly, of Apple, right? Somewhere around there, 5x, 6x. Total stockholder equity on Amazon is $305 billion. And look at cash and cash equivalents plus marketable securities, right? $66 billion in cash equivalents. Marketable securities at $28 billion. Total assets now is $643 billion. Amazon's asset heavy, right? Which shouldn't come as a surprise. Think about all the AWS infrastructure the company has. Think about all the warehouse network all over the globe and all the trucks and the planes and everything like that, right? Now, a couple of other interesting things I thought was worth mentioning here is they launched Interest to find products for customers' passions and hobbies using generative AI. Interesting. They began full-scale deployment of Project Kuiper satellite internet network with launch and activation of first satellites. That's interesting. They began testing their Zoox autonomous driving vehicles in Los Angeles, the sixth location for Amazon's self-driving technology. One of the locations, by the way, is in the city I live in, Las Vegas. Seems like they mostly test around the Las Vegas Strip area, though, and a little off the Strip. I haven't really seen any of these products really in the suburbs, like Summerlin, Henderson, things like that yet. They announced a joint venture to create the next generation of esteemed James Bond film franchise, which is very exciting. The Bond films, always wonderful. They signed new AWS, Amazon Web Services agreements with Adobe, Uber, Ubdi-Booba, NASDAQ, Ericsson, Fujitsu, Cisco, Cargill, Mitsubishi Electric Corporation, General Dynamics, and GE Vernova. So a bunch of big AWS deals, which shouldn't come as a surprise because the world runs on AWS. New foundation models in Amazon Bedrock, including Anthropic, DeepSeek's R1, and Meta Llama 4 family of models, right? So I like it, right? They also announced Amazon's first quantum computing chip prototype that reduces resources needed for quantum error correction by up to 90%, right? Big stuff. It's the thing, like everybody just thinks about Amazon and all those trucks driving around and, think about AWS, but I'm like, this company has just so many things going outside of just those projects, but it's just like, those businesses are so insanely massive that they just kind of dwarf all these other things they're working on, right? Whether it's satellites or self-driving vehicles or quantum chips or, all the other million different things they got going on. No, as far as their guidance went for the company, they guide it to revenue growth of 7 to 11%, right? So you can say midpoint of 9%. What do we know about Amazon? Amazon usually comes in and beats their revenue expectations. So I would expect minimum net sales growth of 11%, bare minimum, but maybe up to 12% or higher, which is very important. You know why? Because if they do that upper range, they're going to have an acceleration of revenue growth. So what we are about to likely go through in regards to Amazon here is an acceleration phase of revenue growth for Amazon. And it's been in some time since we've been in a revenue growth acceleration phase for Amazon. Now you say if they come in with 7%, sure, that would not be a revenue acceleration. That'd be a continued deceleration, which is something we've seen continuously for Amazon for a bit, deceleration. But it looks like they're about to flip over to revenue acceleration again, which is going to be huge for the stock price because we know, you could look at basically every single time Amazon starts going through another revenue acceleration phase, the stock price usually performs tremendous during that time. Operating income for the company, they projected between $13 billion and $17.5. If you look at the same quarter last year, they're at $14.7. What do we know Amazon does? They come in and beat their numbers. So they're probably going to do over $17.5 billion of operating income, which will be a huge, huge increase, right? So that's important. Now, where do I think these stock prices are going from here? Well, Apple is stuck in the 180 to 220 range, okay? And it's stuck there until the company has some sort of major higher or lower growth rate than what it has right now. So if the growth rate was to really stall out here, you would definitely see Apple go lower and probably even under 180. Now, on the flip side, if you get a big acceleration of growth, let's say they were to increase revenue acceleration to like 10% or something like that, then we could talk about the stock could go above 220. But until then, which, is probably for the next 6 to 12 months, the stock is just stuck. It's stuck in the mud probably between about 180 and 220, right? Until they eventually get out of this kind of, single digit mid-range that they're in as far as revenue growth goes, right? Now, additionally, the reason Apple just doesn't have any, major room to move up right now, right, is you've got a stock here with a forward P, looking at 1000xstocks.com, we've got a forward P here of what, 27, 28, but you got a single-digit revenue growth company. For a single-digit revenue growth company that you're expecting to grow anywhere between 2 and 7%, you're just not going to command much higher forward P than that. Like, it's pretty unrealistic. And so that's another reason it just gets hard to get Apple out of this kind of stuck range of 180 to 220, which is just kind of where it's going to drift until we see any sort of major deceleration in the business or acceleration in the business, right? Now, when it comes to Amazon, a little different here. This stock's headed to $200 plus. And here's why, okay? If you look at Amazon's expected revenue growth, you look at the forward P of Amazon somewhere around 29, right? Versus Apple's around, just under 28, right? So roughly same forward Ps, but here's the deal. You're getting around 2x the growth rates with Amazon versus somebody like an Apple, right? So you just got much better growth. You got a forward P that's very similar to somebody like an Apple. And additionally, Apple has a big overhang on it right now, which is Google. And the reason being is Apple generates a massive amount of their services revenue from this Google deal that they have. And there's a potential that the U.S. government is eventually going to basically say Google can't do that anymore. And so people think it's a hit to Google. It's a much bigger hit, in my opinion, to Apple, because Apple makes so much money from that. And it's basically, straight profit for Apple. And so if that changes, it's definitely going to hit Apple to a certain extent, right? Of course, they might have somebody else fulfill that demand, and Apple can still make money, but it's just like, I don't think they're going to make the sort of money that they're making from Google right now. So that will hit Apple if that happens. So Amazon's on its way to 200, but let me show you where Amazon's headed over the next several years. So I have Amazon growing revenue on average 12% per year, 2026 to 2029, okay? I have them doing net income growth of around 20% a year from 2026 to 2029, right? Now, P ratio, an extremely fair P ratio for a company growing at those sorts of growth rates would be 27 to 33. You can make a very strong argument that with those sorts of growth rates, P ratio should be over 35, but I'd rather go a little conservative here. 27 to 33 is very conservative considering these growth rates, which means the stock next year will be somewhere, let's call it between about 210 and 250. The stock in 2027 will be somewhere around, let's call it 250 and about 300. 2028 would be, we can call it about 300 and about, 360, right? And then 2029, we should have a stock somewhere between about $360 and about $440, somewhere in there, right? So I'm expecting Amazon stock to basically 2x in price before 2030. Right? And that's with fairly conservative estimates. Once again, you can make an argument that the multiple the stock should be able to command is much higher than where we're at here. And, to be honest, especially with share buybacks and things like that, you can make an argument that earnings per share could increase on average by much more than 20% per year over the next, 4 or 5 years. So the moral of the story is, come 2029, I'm expecting to have at least doubled my money in Amazon from where it's at now. So when you see I have, let's say, $200,000 in the public account in Amazon, assuming I don't buy any more shares over the next several years, which I might continue to buy shares, if we're going to look out a few years from now, that should be at least $400,000. And the important thing I just took you through there is how you got to think as a higher level investor if you ever want to be like really good investor. Because what a lot of people fall into a trap is they just throw stuff out there like, oh, I think stock blah, blah, blah is going to $1 trillion. Okay, why? Because of, it's got a big thing it's going after. Okay, what does that mean for the revenues? What does that mean for the net income? What does that mean for the margins? It's got a big thing. That's not how you invest, okay? It's like you want the big account, you want the big dollar amounts, you want to make huge gains, you want to have the big house, you want to have the nicest cars and go on the nicest vacations and do all that stuff. You can't be a fool in this game, man. You got to actually run the numbers for real. You got to run real projections here. You got to do it on a high level. Otherwise, you're just throwing stuff out there and hoping it sticks, right? And sometimes if you're in a really bullish market, it does stick. And that makes you think like, oh man, this foolish way I'm doing it is just throwing stuff out there. That's a smart way. No, it's not. You're going to end up in a lot of trouble like that. You got to actually run numbers, run projections, run a bull case, a base case, a bear case on a stock. Like, perform up to a much higher level, and then you'll get to much better places, right? Alrighty, let's go ahead and react to some videos up here, right? And on 1000xstocks.com, right, we have the intermediate projections that you can run. We also have the advanced projections. So if you really want to go crazy with it, you can run advanced projections and save your files all in 1000x now. So you get access to that if you join my private stock group, private wealth group.
6%. So basically guidance, the revenues, at least the bracket was above where consensus is. I mean, consensus is at the bottom of the bracket. But there's a big asterisk here with this guidance.
So if you're, it's the second quarter operating income guidance, which was 13 billion to 17.5, and the street was at 17.6. So that ratcheted things down. Okay, that's fine. But then you look at the quarter itself, 11.8% operating margins. I mean, that's pretty extraordinary, I think. The street was looking for 11.3. It's up from 10.7.
Oh, don't even get me started on Amazon margins. Like, those are going to increase rapidly over the next few years. Like, we're still early. We're still very early in the Amazon margin story. Just understand that. Like, the margins you're looking at today are nothing compared to where Amazon margins are going to be out 5 years out, 7 years out, 10 years from now.
There we go. I mean, these are all good numbers. You can nitpick here without question, and maybe Cloud disappointed a little bit, but I think you hit the nail on the head. I think that guide is giving people a little bit of a concern.
And drilling into that margin, operating income margin at AWS beat at Street, I think, by 350 basis points. So this profitable part of the business that we all know, some people say you get e-commerce for free, is part of the story. I think it just gets into, Amazon has always had some cyclicality to it, and I feel like that's a term I know I've been using this week on Fast Money, because I do think it's very important when we think about a week when we've digested not some great macro, and we're trying to contemplate what's really going on in addition to tariffs. And I think in the case of Amazon, that's part of the story here. I do think that the e-commerce business, it's a secular trend. It's their business to control and dominate, I think. I mean, Walmart would say something different, but I think on AWS, again, growing cloud, and then they had this marketing business. So, I mean, I like it. I like it relative to itself on valuation. I think you have plenty of headlines.
What movie is this from? I like it. I like it a lot.
Great for Amazon, but I think in the medium term, you love this stock.
I don't think there's anything specific. It's just the nature of this market right now. We know macro is the big thing. Amazon's been an uptrend for the past 2 years. Yes. Amazon drops hard with almost every other stock starting in February. Yes. Amazon's ricocheted. Yes. And here it is sort of in the middle of the tennis court, if you will. No man's land.
If you were, I mean, did I just hear a pair of twos?
It might just
sort of.
Which
I learned just the other day was the worst hand you could possibly have, except for 5 random cards. I didn't even know there were 5 cards in the hand, but now I learned a lot that day.
No, but pair of twos. But we talked about 2-7 offsuit being. You don't want that.
Yeah, I don't know what you're talking about.
Let's move on, guys. Okay, Mel, I'll do that. What all these stocks have in common, though, and the broader market does as well. The 50-day moving average crossed down through the 200-day. We've talked about this ad nauseum on the show, this death cross. All these individual names and the S&P 500 all have traded back up to the 50-day. Some have overshot it. Microsoft, for example. The question is, were those death crosses or that formation, is it strong enough to thwart what has been some good quarters? And to Carter's point, all these moves have gotten us back to a level. Is it, in fact, a pair of twos that you fade? We're going to find out over the next couple of days.
All right, let's get more on these tech results with Deepwater Asset Management's Gene Munster. Gene, great to have you.
I'm Melissa.
Let's kick it off with Amazon, since we were just talking about that. You think the guidance is actually better than how the street is interpreting. Can you explain?
Exactly, Melissa. They typically come in at the high end of their range, and so you have to factor that in. Look at the high end. The high end was 2% higher than where the street is at for the June quarter. And that really is a powerful statement relative to the macro we're in. That's what I'm curious to hear on the call, is like what was factored into that. Were they being conservative? Were they taking the current environment and running with it? Whatever that might be. But that piece on the operating income side, a lot of people looked at that as a disappointment. Again, you have to go to the high end of the range that was in line with the street. So the way I look at this, they guided revenue up by 2% in a really tough retail market. So I see that as a net positive.
True. Can't debate that, right? And all these worries about the Chinese retailers and Temu and whatever the other companies are named, right? There's all these worries about those companies are kind of gonna fade here now that the Trump administration is changing a lot of the rules in regards to how those companies ship products, right? You could also look at that and say that might end up being a net positive for somebody like an Amazon in the end, right? Because more money that could be going to Amazon rather than going to those Chinese e-commerce companies that are sending $5, $20 packages over here, right? So there's just another thing to factor in there. But I mean, at the end of the day, like, Amazon's just a buy. As I tell you guys all the time, Amazon's been a buy for over 25 years now, right? And it remains a buy today, right? It's just one of those stocks you want to make easy money. Make easy money, man. Easy peasy. Lemon squeezy.
Debbie Downer, but here's what we saw and what we didn't. Now, those two reports ease some of the biggest concerns around the AI trade this year in terms of demand and monetization. Microsoft affirmed CapEx, Meta raised its, GitHub Copilot users up 4x, Meta's AI-powered ad tools gaining adoption. But have concerns really been put to bed? Not quite. Zoom out and Microsoft's CapEx last quarter was actually its first quarter-over-quarter decline in years. A potential yellow flag, at least if you're betting on uninterrupted AI build-out, digestion or recalibration. That's not totally off the table with this report. Meta, meanwhile, did raise its CapEx plans by as much as $7 billion, but that comes with a caveat too. Goldman Sachs expects depreciation is set to spike to nearly 50% in 2026, and Meta's own CFO told investors that infrastructure build-out costs, they will rise, driven by supply chain uncertainty and potential tariff impact. Then there is this chart. The scale of Meta's spending is eye-popping when you put it into context.
True.
It is projected to spend a bigger share of its revenue on CapEx than even Microsoft, Google, or Amazon, the hyperscalers, all of which have massive public cloud businesses.
Okay, so there's a few ways you could look at this. One is Meta's the most sure of any of the companies that they're going to get a massive payback from this, right? Yeah, that's one way you could look at it. Second way you could look at it is Meta's just, spending like a drunken sailor. They're just ridiculous over there, okay? It's crazy. Okay, you can look at it that way. Third way you can look at it is because Zuckerberg leads Meta, it's very different than Sasha leading Microsoft, right? Very different than Sundar leading Google McDougal, and very different than Andy Jassy leading Amazon, right? Those guys were executives that became CEOs. Zuckerberg's the guy, right? And so Zuckerberg's the only one that has a real leeway to spend this aggressively. So that's another way you can look at it. That's a third way, right? But at the end of the day, the way I would look at it is it's clear the one who's benefiting the most from AI so far. This does not mean they're going to necessarily benefit the most over the next 5-10 years, but it's very crystal clear that if you look at all of the big tech companies outside of NVIDIA, the company that's benefiting the most from AI today is Meta, right? Like, they're the ones that are seeing the most direct return on their AI spend right now. And keep in mind, we're so early days here. Like, we're only really in the first year of even thinking about making some money from AI related stuff, right? And this is a game that's going to play out over the next decades. Not over the next year, over the next decades, right? Like, long game to play here.
Demand. Meta doesn't have that enterprise backstop. Its bet is largely on Llama, its open source AI model family, which is, by the way, underperforming the benchmarks and facing growing open source competition from fast rising Chinese models like DeepSeek and Alibaba's Qwen. Carl put it well earlier in the show. How much spend is reasonable chase in the overall contest? And at what point is it undisciplined behavior? This chart calls Meta spend into question. For shareholders, though, this also means that there's less capital available to return to them. Meta's quarterly share buybacks were down 11% from last year, and it didn't do any in the fourth quarter. So whether the mega cap comeback is real, that remains to be seen. There's still questions. Amazon and Apple tonight.
But here's the thing, right? Meta, on a constant currency basis, just grew revenue by how much? 19%. Now compare them to Google. They grow much more rapidly than Google. Compare them versus compare them against Amazon. Meta's growing much more rapidly than Amazon, right? Compare them against whoever you want to. Compare them against Apple. The growth rates are not even in the same stratosphere, right? And so if you want to look like who's really the leader, it's Meta by a mile. All these other companies have revenues that are, up a very small amount compared to what Meta's revenues are up, right? So I think that's something to kind of keep an eye on here. And it looks like Meta's just winning. Like, regardless of what opinions are, 19% revenue growth on a constant currency basis speaks for itself. 19%? Find another big tech growing at those sorts of growth rates other than nvidia. Good luck.
Help to either validate that thesis or walk back today's exuberance. There are also, of course, guys, we're well aware of them. We talk about them every day. Those macro and regulatory risks still looming, like changes to the AI diffusion rule that could make it harder for NVIDIA to sell GPUs abroad, and the many lawsuits and scrutiny building up both here and overseas.
I still go back to that big DeepSeek sell-off day, Deirdre, because, if you look at a chart of the Magnificent Seven, that's really where it started. Yes, Liberation Day didn't help, but there was a bigger decline into that from DeepSeek than after the tariff announcements. And I just wonder if some of those sort of big psychological questions have been answered with any of these earnings. The competition from Chinese open source models like a DeepSeek, the return on investment for names like a Meta or an Alphabet, and whether it's worth all of that spending, given what we saw from DeepSeek. Those are just the two big ones. I'm sure there are more.
That is exactly right, Sarah. If you look at April, right, we had the so-called Liberation Day, but it's been extremely volatile. The moves haven't actually been that big. I do always go back to that DeepSeek moment, that huge Monday sell-off that raised all these questions about efficiency and the commoditization of large language models. That is still very, very much a factor. And I remember at the beginning of that, too, you probably do too, Sarah, there were questions around Meta. Meta was seen as benefiting, right, because this was an open source model that arrived on the scene, and the only really big company doing open source here was Meta. But actually what's happened since then, it's actually exposed a lot of the vulnerabilities and weakness in the Llama model and showed that it's not just DeepSeek, but it's Alibaba's Qwen. There's a new model from Xiaomi. There's just so much Chinese competition in open source, which is so much cheaper than what OpenAI and Anthropic and others are doing. This has absolutely changed the paradigm, and you're exactly right to point back to that moment.
Yeah, although Laura Martin said, I don't know how, she doesn't know how they're going to spend the money this year, and they don't always hit their target, even with the guidance. Dee, that's
great point. They are willing to walk it back sometimes.
But she's also been bearish on Meta for the last few years. I missed the whole rally.
Dee, thanks for helping us frame it. So important. Our Deirdre Bosa.
That was awesome. I laid out exactly what all these big tech companies are going to do in regards to CapEx for the last several years, right? Told you 2024 was going to be a massive jump up versus 2023 spend. Told you 2025 is going to be a whole new level of spend, like quite substantially over 2024. But as I stated many times, 2026 is a year that you will start to see very slow growth rates in regards to how much these companies are spending versus what they spent in 2025. And I have no reason to disbelieve that. I believe when you look at Meta, Microsoft, all these companies, it's not that they're going to stop spending on AI. It's just the rate of growth is going to slow substantially. And is going to get to, in my opinion, much healthier levels. Because right now, some people are freaked out with how aggressively these companies are upping the amount of spend on a percentage basis, right? Which I understand. But things are going to get much more evened out starting in 2026, 2027. And so these companies, it's not like they're going to say, oh, we're not spending on AI. They're still going to spend just as much as ever. It's just the rate of growth is going to be much smaller, much more controlled, and it'll be much healthier, in my opinion, right? And then it's going to be really fun because you're going to start to see a lot more results, a lot more money pour in for these companies that have been doing all this spend, which is going to be, in my opinion, very, very fun times. And that will be the next huge leg higher for a lot of these, obviously a lot of these companies that are spending aggressively there.
CIO, Mike Wilson. It's nice to see you.
How are you, Scott?
So I'm good, thank you. And it's great to have you here. So we need to see four things. I don't like doing lists like this because, it puts you on the spot. If you forget something, it's on you, not me. But what's the four?
Yeah, so, it's not all four, but we need to see some combination of these four things. I'd say the first one is some deal on tariffs with China. Okay. That's the one that matters.
All right, check.
Okay. Number two, dovish Fed. Okay, where they kind of get off the stick. Okay, number three, we see rates come down in a more meaningful way, the back end of the market, without growth really deteriorating. Okay, and then the fourth one, which is probably the most important for stocks, is earnings revisions. Earnings revisions have been on a downward trajectory for quite a while, but if that were to turn up, so maybe one or two of those together, we could see a breakout of this range we've been stuck in.
Does that suggest that you're not yet convinced that this rally back?
By the way, in regards to Fed, because I feel like we haven't talked too much about the Fed here over the last maybe week or two, the Fed's looking easier and easier to, start the next cut cycle, right? They already did their first cut cycle. They look ready to get started with the second cut cycle now. And the reason being is you look at a lot of the economic data is showing, you look at the GDP numbers, right? You look at the JOLTS data. There's enough underlying data for the Fed to say, okay, we got to start going. We got to start going on our second cut cycle. So what we're going to see is a second cut cycle start here probably in the next, my guess is in the next 60 days. They'll start their next cut cycle, and then it's going to be cut after cut after cut for a while. I'm just trying to figure out, are they going to cut 25 basis points a time or 50 basis points? I think that's really the only debate at this point in time, right? If I was them, I'd lean toward 50 cuts, 50 basis point cuts each time, and probably line up 4 in a row.
8 in a row, I think we're going today on the S&P, is sustainable?
Well, I would say this. The lows could be in. Okay, we priced a lot of damage at 4,800 on April 7th. There was a capitulatory move. I think the wild card now is, are we going to have a recession? Okay, and I think, our economists would say it's a coin toss. It's a 50-50. I think most of your guests are probably in this.
Hey, they're starting to go to what I was telling you guys. I told you guys lows are already in unless you get another black swan event, right? That's what I told you guys, right? And now these Wall Streeters are starting to go to my side. They're like, lows might actually be in, right? So the only way we got to lower lows than what we had there in that early April time is if you got another black swan event. Other than that, you're good.
Boat. I think most commentators, we just don't know. And if you don't get a recession, the lows are in, okay, for the year. If we get a recession, you probably got to do a full retest, maybe a slight break, okay, and that would be a labor cycle. That's the only way to define a recession, is a labor cycle. All this stuff about negative GDP, I don't care about that. I care about, do companies start laying employees off in a way where you get a next round of revisions that become more serious?
We both know, for obvious reasons, we're not going to have an answer to that question for a while. Does that mean that we just chop around things? We may have some volatility come back. We feel like it's been this nice little sanguine move higher. Everybody's feeling good. As Adam Parker was just saying, everybody was so negative. Now everybody's feeling so much better about everything. But are we due just for more choppy?
That's basically our call. It's a range trade, right? So the low end of the range is sort of 5,000 to 5,200. Upper end of the range now is 5,500 to 5,600. That's a pretty good range to think about in S&P terms. Now, a lot's going on under the surface as usual, right? So a lot of the economically sensitive parts of the market have been correcting for almost a year, right? They've been in a downtrend for quite a while. That's where the value is. The problem is you can't really step into a lot of those stocks if a recession is still 50%. So, yeah, it's going to be a trading environment. There's probably some franchises you can kind of go back to that look a little bit more interesting. The weaker dollar is helping the multinationals now. That happened with Microsoft and Meta last night for sure. And that was sort of our view coming into this week that, don't forget about the dollar. The dollar has made a big adjustment, and that can help earnings growth.
If it stays, the dollar index is up quite nicely today.
Yeah,
right? It's a pretty big move for a single day.
But the trend is down.
You still think so?
I think the trend is down. I think we've made probably a multi-year top in the dollar. The dollar is overvalued. That doesn't mean we're going to crash in the dollar. But gold's been telling you now for a long time that the dollar, all currencies are somewhat overvalued, and the dollar in particular relative to other currencies. So that's probably the thing I have the most conviction in, is that the trajectory of the dollar is weaker, and you can't get too bearish on the multinationals, because that's helpful for earnings growth.
I find from people saying now you just can't get too bearish on anything, because there could be a deal, whether in quotes or not. Anything could happen that flips the switch to a more positive outcome. Just as people feel like they're foggy, well, the fog could lift pretty quickly, don't you think?
Well, I think that's what we got, right? So we had a pretty nasty sell-off. We did see some pivoting on the tariffs, some headlines that were more favorable, and that's why we're up 700-800 points in a straight line. So I still think this range will hold for a period of time. I'm not convinced that this is a sustainable rally beyond 5650, which you wrote about this week. I think retesting the low end of the 5,000 range is feasible even without a recession. And, of course, if you get a recession, then all bets are off.
Yeah, which, leads me to that kind of disbelief, that second guessing of market can't go any higher. That's exactly why the market can go higher, whenever the Wall Streeters kind of think oh, this can't happen, it does happen, right? But I take you back to 2018, which this year has reminded me so much of 2018. And I've been talking about that for months and months now, right? It's scary how close it is to 2018. 2018, at the very beginning of the year, things were looking good. Then shortly after, we had some major drops in the market, exactly what we've seen play out, right? Then we went through a ripper rally in the spring into the summer, and then we got a massive fall in the fall, right? And to say that it's not going to happen this go around, like, it's setting up like literally perfect. Like, it's setting up perfect to what happened in 2018. So we'll see. But if you get a ripper rally throughout this spring and into the summertime, don't be surprised if then come fall time, we get a fall in the market, a big, sharp, nasty fall, right? That shakes everybody up in a major way, right? So, but we'll see. Like, maybe it's not 2018, but it just is a lot of that's going on this year that I'm like, dang, this is reminding me a lot of 2018. Crazy, but we'll see how it all plays out. Hey, appreciate you guys joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. I'm glad you guys enjoy the reaction channel. Additionally, if you're looking to take your investing game up to a much higher level than where you're at, you want access to all my best courses like Become a Master of Stock Market, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, Financial Statements Mastery, access to my private Discord chat, all that good stuff. Pin comment down there, click on that, fill out a form, see if we can get access either this weekend or next week. Much love and have a great day.